Good morning. Today we are initiating coverage on Volt-Core Semiconductor, ticker VCORE, with an outperform rating and a 12-month price target of $485, representing a 28% upside. While the broader market fixates on front-end compute and leading-edge GPU designers, the structural bottleneck in artificial intelligence infrastructure has definitively shifted to power management and thermal efficiency. VCORE operates as a pure-play monopsony proxy in high-density power management ICs, or PMICs. As hyperscalers deployed next-generation accelerators, the power density requirements have outstripped legacy 12-volt rack architectures, forcing an industry-wide transition to 48-volt systems. VCORE commands a dominant 65% market share in these specialized voltage regulators. Our thesis is predicated on structural EPS accretion driven by this mix shift, robust pricing power, and an expanding total addressable market that Wall Street consensus is currently under-modeling by at least 15% over the next 8 quarters. Let us examine the underlying market dynamics driving this fundamental shift. The exponential increase in large language model parameters is directly correlated with a surge in GPU thermal design power, or TDP. 2 compute generations ago, standard server processors required approximately 300 watts. Today, flagship AI accelerators are breaching the 1,000-watt threshold, and next-generation silicon is projected to hit 1,200 watts. This creates a non-linear escalation in power delivery complexity. The traditional data center infrastructure is simply ill-equipped to handle high-current, low-voltage power distribution with catastrophic transmission losses. VCORE's proprietary monolithic silicon processes reduce board space requirements by 50%, while improving power conversion efficiency by 300 basis points. We forecast the high-density AI server PMIC market to compound at a 35% CAGR through 2028, creating a structural tailwind that virtually guarantees top-line outperformance for the incumbent market leader. Evaluating VCORE's competitive moat requires an understanding of their vertical integration and proprietary packaging technology. Unlike fabless peers relying on commoditized foundry BCD processes, VCORE utilizes a highly customized bipolar CMOS/DMOS technology stack. This allows them to integrate the control IC, driver, and MOSFETs into a single monolithic die. The operational result is superior transient response, the ability to handle the massive, instantaneous power spikes generated by generative AI inference workloads without triggering system faults. Furthermore, as server racks migrate to 48-volt distribution to mitigate resistive losses, VCORE's direct-to-point-of-load conversion topology effectively eliminates intermediate bus converters. This architectural dominance creates exceptionally high switching costs for OEMs and hyperscalers. Displacing VCORE from a reference design introduces unacceptable failure rate risks for $100,000 server nodes, effectively locking in their market share for the duration of the current architectural cycle. Turning to the financial profile, VCORE presents one of the most compelling operating models in our semiconductor coverage universe. We project a base case top-line CAGR of 25% over the next 3 fiscal years, entirely driven by volume scaling in the enterprise AI segment and ASP expansion from higher-tier product mixes. More importantly, we are modeling significant gross margin expansion, historically ranging between 52 and 54%. While data center AI constitutes the primary catalyst, VCORE's total addressable market expansion into adjacent high-margin verticals provides vital downside protection and cyclical dampening. The automotive segment, specifically advanced driver assistance systems and vehicle electrification, represents a secondary growth vector, compounding at 22% annually. Modern EV architectures are mirroring data center power challenges, transitioning from legacy 12-volt to 48-volt zonal architectures. VCORE's high-reliability automotive-qualified PMICs are securing multi-year design wins with Tier 1 OEMs. Additionally, the proliferation of edge AI, deploying localized inference capabilities in industrial robotics and enterprise hardware, requires rigorous power efficiency due to strict thermal envelopes. This diversification shields the top line from transient hyperscaler CapEx digestion periods, establishing a highly resilient recurring revenue baseline that commands a premium multiple in public markets. Moving to valuation, VCORE is currently trading at 35 times our next 12 months EPS estimate and 28 times EV to EBITDA. At first glance, these multiples represent a premium to the broader analog semiconductor peer group, which averages 22 times forward earnings. However, this superficial premium is entirely justified when adjusting for growth. Applying a price-to-earnings to growth or PEG ratio methodology, VCore trades at a highly attractive 1.1x compared to the peer average of 1.6x. We utilize a 10-year discounted cash flow model, assuming a weighted average cost of capital of 8.5% and a terminal growth rate of 3.5%, yielding an intrinsic value of $490 per share. Given the high visibility of their order book and structurally embedded margin expansion, we argue that the market is mispricing the durability of VCore's economic rent.
A critical component of our bullish thesis rests on VCore's pristine balance sheet and capital allocation framework. The company maintains a net cash position of approximately $1.2 billion, with zero long-term debt maturities until 2030. This unlevered fortress balance sheet minimizes cost of capital risks in a structurally higher interest rate environment. Free cash flow generation is exceptionally robust. We project an FCF yield of 3.5% for the current fiscal year, expanding to 4.2% next year as CapEx intensity normalizes post-capacity expansion. Management has demonstrated disciplined capital allocation, recently authorizing a $500 million accelerated share repurchase program, effectively mitigating stock-based compensation dilution. This high-quality earnings profile, characterized by 95% cash conversion, is exactly the metric institutional allocators demand during late-cycle market dynamics.
To maintain objectivity, we must examine the bear case and associated tail risks. The primary risk vector is customer concentration and insourcing. Currently, the top 3 hyperscalers account for roughly 40% of data center revenue. There is a non-zero probability that these entities, and their relentless pursuit of cost optimization, attempt to design custom power management ASICs to bypass merchant silicon vendors like VCore. Secondly, VCore relies heavily on specialized foundry partners in Taiwan. Any geopolitical friction or supply chain disruption in the APAC region would severely impact their ability to fulfill backlog, given the bespoke nature of their manufacturing process. Finally, a macro-driven deceleration in corporate IT spending could cause a cyclical digestion period for AI server deployments, resulting in multiple compression as momentum investors rotate out of the semiconductor sector. Conversely, our bull case scenario yields a price target of $560, representing over 50% upside from current levels. This scenario materializes if the AI CapEx cycle extends well into 2027, rather than peaking next year. If hyperscalers accelerate the deployment of liquid-cooled, ultra-high-density racks, the ASP for VCore's premium voltage regulators could double. Furthermore, if the automotive segment adoption curve steepens due to regulatory mandates on EV efficiency, we could see an EPS upside surprise of roughly 20% above current consensus for fiscal 25. In this regime, the market would likely re-rate the stock to a 45 times forward PE multiple, recognizing VCore not merely as a component supplier, but as a critical infrastructure utility underlying the global transition to machine learning and automated systems. In conclusion, VCore represents a highly asymmetrical risk-reward profile for institutional portfolios seeking pure-play exposure to the AI infrastructure build-out. It circumvents the valuation risks associated with crowded front-end compute names, offering a backdoor entry into the generative AI secular trend. We recommend a core overweight position, utilizing any macro-induced volatility or technical pullbacks to the 50-day moving average as accumulation opportunities. The fundamental quantitative metrics, 31